Welcome back to Investing Talk Podcast.
Today we're looking at TSMC.
As usual, before we start, subscribe, like, and comment to this video to support the show.
It really, really helps us out.
It does. And honestly, you're going to want to stick around for this one.
I think so, because we're not just talking about another chip company. We are talking about, well, maybe the single most critical bottleneck in the entire global economy right now.
Okay, bottleneck of the global economy. That sounds like a bit of an exaggeration, doesn't it?
It sounds like it, I know, but it might actually be an understatement. I mean, think about it this way.
Okay.
We spent all this time arguing about which AI model is better. You know, is it Gemini? Is it GPT-5? Who wins?
Right, the software wars.
The software wars.
Yeah.
But none of it, literally none of that software runs without the hardware. And right now, there is effectively only one company on Earth that can make the silicon brains for this whole AI era.
TSMC.
TSMC, Taiwan Semiconductor. They're the engine. And if that engine stops, the whole car crashes.
And there's a news hook here, right? They just dropped a big report.
A massive report. Their January 2026 revenue didn't just beat expectations, it completely shocked the market.
Okay, let's unpack this, because usually manufacturing is the unsexy part of the chain.
The dirty work.
Right? Heavy lifting, low margins. You want to own the designer like Nvidia or the software like Microsoft.
Yeah.
But you're saying the real power is here.
That's what the numbers are telling us.
So what does this mean for the investor who thinks they maybe missed the big AI rally?
It means we need to look at the numbers, because the story has fundamentally changed. The thesis isn't recovery anymore. It's acceleration.
All right, let's get into it then. You said a shock revenue report. What are we looking at for January?
We were looking at velocity, pure, simple velocity. For the month of January 2026 alone.
Just 1 month.
Just 1 month. TSMC brought in 401.26 billion new Taiwan dollars.
Which is what, in U.S. dollars? About 12.7 billion?
Roughly 12.7 billion U.S. dollars, yeah.
And in a single month.
But look, the raw number isn't even the headline. The headline is the growth rate. That is up 37% year over year.
37%. Let's pause on that for a second.
Yeah.
For a hardware manufacturer of this size, I mean, we're talking about a $1 trillion company. That is, well, it's absurd.
It's absurd.
You see that in a software startup, maybe not in a heavy industrial titan. That's unheard of.
And you have to remember the context. Think back to late 2025, just a few months ago.
Right. Things were slowing down.
Growth was slowing.
Mm-hmm.
And there was this whisper, this fear in the market that, maybe AI demand was cooling off. Maybe the hyperscalers had bought enough chips.
The AI fatigue narrative, I remember that maybe companies needed to pause and digest what they'd bought.
Well, this January report just took that whole narrative and threw it out the window. A 37% jump. That signals a massive reacceleration.
So the big tech companies, they're not stopping, they're doubling down.
That's what it looks like.
So if they're starting the year like this, what are they projecting for the full year? Because 1 month can be a fluke.
That's fair. But they're guiding for 30% revenue growth for the full year of 2026.
30%. Okay, I'm looking at the Zacks data here. They're projecting full year revenue at $198 billion.
Up from $122 billion in 2025.
That's an $80 billion jump in 1 year. Just to put that into perspective for you, $80 billion is the entire annual revenue of a company like Boeing.
Wow.
They're adding a Fortune 500 company to their top line in 12 months. The scale is just, it's hard to wrap your head around.
And here's where it gets really interesting. It's not just volume. It's about what they're selling. The mix.
It's secret sauce.
Exactly.
Okay.
We're not talking about cheap chips for your toaster.
Yeah.
This is all driven by their advanced technologies.
So 7 nanometer and below.
Right. And that now makes up 77% of their total revenue. But the real star, the crown jewel, is the 3 nanometer chip.
The bleeding edge.
The absolute cutting edge. In Q4, 3 nanometer chips jumped to 28% of their revenue.
Up from what, 23%?
Up from 23% just the quarter before. That is a massive shift very quickly.
Okay, can we just explain 3 nanometer for a second? Why does that matter so much? Is it just that it's smaller?
It's smaller, yes, but it's about density and efficiency. The smaller the node, the more transistors you can cram onto the silicon.
With more power.
More power, but crucially, they're way more energy efficient. And when you're running a data center that uses as much power as a small city, your electricity bill is your biggest cost.
Ah, so paying a premium for that 3 nanometer chip Saves you billions in electricity over the life of the server.
Exactly. It lowers the total cost of ownership. That's why Nvidia needs it for their new GPUs, why Apple needs it for the iPhone. And right now,
TSMC is the only one who can make them. At scale.
at scale and with a good yield rate, which is key.
Meaning, how many of the chips on a wafer actually work?
Right. Samsung is struggling to get their yields up. Intel is. Well, Intel's having a hard time. So TSMC is really the only shop in town.
But let me play the skeptic here.
Yeah.
Growth is great, but it's incredibly expensive in this business. Building these fabs, they're the most expensive buildings on Earth. And there are spending guidance. It makes me a little nervous.
You're looking at the CapEx.
I am. They raised their 2026 guidance to between $52 and $56 billion.
It's a staggering number.
It's a huge number. In 2025, they spent, about $41 billion? So that's a 27 to 37% jump in spending. That feels like betting the farm. If that demand falters even a little, the depreciation costs will crush them.
It feels like that, but you have to look at why they're doing it. They aren't building empty factories hoping customers will show up.
This isn't a field of dreams.
No. This is capacity that is almost certainly already spoken for. The Mag 7 are begging them for more. And critically, look at their balance sheet.
Right, they're not funding this with debt.
Not really. They have incredible free cash flow. They can fund most of this from their own operations. It's a fortress balance sheet.
Which leads to the moat, I guess. Because if you're spending $56 billion a year just to stay in the game, who can possibly compete?
Nobody. That's the whole point. Overall, TSMC has about 60% of the foundry market. But that number is misleading.
How so?
Because that includes all the cheap, older stuff. If you only look at the advanced chip market, the stuff that runs AI, TSMC's market share is 90%.
90%.
90.
So it's a monopoly.
Effectively, yeah. And the switching costs.
Yeah.
I mean, think about it. If you're Nvidia, you've designed your whole architecture around TSMC's 3-nanometer process.
You can't just walk over to Samsung and ask them to make it.
No. It would take years and billions of dollars to redesign. Plus, TSMC has this packaging technology, CoWoS.
Chip on wafer on substrate.
Exactly. It's this advanced way of stacking chips together. It's a huge part of the secret sauce. And no one else can do it at their scale.
So you're locked in.
You're completely logged in. And meanwhile, you look at Intel, they're talking about capital discipline. They're being cautious.
Oh, well, TSMC is sprinting.
They're sprinting while their rivals are jogging. The gap just gets wider.
Okay, it's a great story. The fundamentals are incredible. But does the price action actually back this up? Let's pivot to the charts. Do the technicals tell the same story?
Well, looking at the technicals, the market seems to be paying very close attention. Year to date, so just in 2026, the stock is already up 13%.
And that's significant when you compare it to the rest of the sector.
It is. The broader tech sector is actually down about 3% this year. Even Nvidia is down about 1%.
So TSMC is outperforming its own biggest customer.
Yeah. That's a telling divergence.
Why do you think that is? They usually move together.
I think investors are rotating. You know, everyone owns Nvidia, everyone owns Microsoft, valuations are stretched. So they're looking for where the value is.
And the hardware maker was comparatively cheap.
Exactly. And the long-term trend is just a monster, up 180% in 2 years, up 1,500% over the last decade.
A wealth-generating machine. What about the immediate reaction to the January numbers?
The market loved it. Shares jumped 3.6% to hit 1,880 new Taiwan dollars. And that looks like a breakout level on the chart.
It is. It's breaking out of a recent consolidation. And this goes back to that flow narrative we talk about, the big institutional money.
Is looking for a home.
And they want that pure play exposure. If you buy TSMC, you're not betting that Gemini beats ChatGPT. You're just betting that AI is going to happen.
You're selling shovels in a gold rush.
And you're the only one with shovels. The caution from Intel is actually driving money into TSMC.
The chart definitely implies that as long as the AI story holds, we're looking at sustained higher highs. The volume is there.
Okay, so numbers are good, chart is good. Let's talk about how the street feels. Pivot to sentiment.
This part's interesting because if you just look at the quantitative news scores, the algorithms, they're actually rating recent news as neutral.
Neutral. How is 37% revenue growth neutral?
Well, the algorithm sees that massive CapEx number, the $56 billion, and it interprets that spending as a risk factor. It introduces uncertainty.
But the humans, the actual traders,
they're interpreting it as bullish aggression. They see it as confidence. They know management wouldn't spend that money unless they were sure it was going to pay off.
And the analysts are backing that up. Zacks just made TSMC their bull of the day.
Rank #1 strong buy.
And it's driven by upward earning provisions. Analysts are scrambling to upgrade their models because they got the slowdown wrong?
It's that narrative shift we talked about.
Yeah.
In late 2025, it was all fear. AI demand is slowing.
Is the bubble popping?
And now it's the AI arms race is back on. That record revenue it eased all the fears.
It confirmed the dip was just a blip.
Yeah. And you see it in the institutional flows, too. Smart money sees this as the safer bet than trying to pick the software winner 5 years from now.
Okay, but it can't all be green candles.
Here we go.
We have to look at the bear case. And there is one giant elephant-sized risk that we have to talk about.
Geopolitics.
Geopolitics.
Yeah.
Taiwan.
You can't talk about this company without talking about it. It is the #1 risk. If anything happens in that region, the stock is in serious trouble.
It's the existential risk. I mean, there's the Silicon Shield theory that TSMC is too important to the world for anything to happen, but that's a geopolitical gamble, not an investment thesis.
So what's the mitigation strategy?
Well, that's the Arizona expansion, that $165 billion commitment to build fabs in the U.S.
Geopolitical insurance.
Exactly. It's about diversifying the supply chain and unlocking those U.S. subsidies.
But those fabs aren't fully online yet. And you hear rumors, right? Delays, labor issues.
Yeah.
The culture clash between the engineers.
That's putting it politely, yeah. It has been a challenge. And maybe the subsidy checks aren't clearing fast enough, but the commitment is there. The fabs are being built. And at the end of the day, the market is weighing the probability of a catastrophe against the certainty of the cash flow. And right now, the cash flow is winning.
What about another risk? Demand durability. You mentioned that dip in October 2025 to 16.9% growth.
Yeah, that caused a panic.
What's to say this 37% isn't just a one-off burst?
It's a valid concern. Monthly numbers are volatile, but that's why you have to look at the full year guidance.
30%.
30%. Management sees the order book from Nvidia and Apple. If they thought January was a fluke, they would not be guiding that high.
So they see the pipeline.
They see the pipeline. And with AI models getting 10x, 100x bigger, the demand for these chips isn't going away.
Okay, so that brings us to the verdict. We've looked at the numbers, the charts, the sentiment, the risks. Where do we land?
I think the scorecard is pretty clear. For me, this is a bullish score of 9 out of 10.
9 out of 10, that's high. You usually dock more for the geopolitical risk.
I did dock a point for it, otherwise it would be a 10. But look at the thesis. TSMC is the arms dealer of the AI era.
I like that analogy.
In an arms race, you bet on the guys selling the weapons. They have 90% of the advanced market. They win no matter which software company wins.
They all have to pay the toll to TSMC.
They all have to pay the toll. The momentum is unstoppable. And their rivals are lagging. So I have to concede, even with the Taiwan risk keeping me up at night, the cash flow is just undeniable. It's very, very hard to bet against a monopoly that is printing money this fast.
So this isn't a trade, it's a hold.
It's a multi-year hold, a compounder. The semiconductor industry is marching toward $1 trillion in sales.
1 trillion.
And TSMC is the gatekeeper for the most valuable part of that. You buy it, you hold it, and you let the AI revolution do the work.
A compelling case. The gatekeeper to the trillion-dollar industry.
That's the bottom line.
Well, there you have it. A 9 out of 10 for the engine of the AI world. A massive revenue beat, a breakout chart, and a very profitable future, assuming the world stays stable.
High risk, massive reward.
Exactly. Well, that wraps up our look at TSMC. Make sure to subscribe, like, and comment to support the show.
We want to know what you think. Are you buying this breakout, or is that geopolitical risk just too much for your portfolio? Let us know in the comments. See you next time.
Thanks for listening.